The PE ratio of a stock, or the price to earnings ratio. This can also be called the price multiple or the earnings multiple. So in the beginning, I used to think that a higher PE ratio was always better. And I'm glad that I didn't state that before because I was waiting to do this video. And if I did, I'm not 100% sure if I did, but I'm pretty sure I didn't. I would just say the PE ratio of each company that I was going through because I was a bit confused. I wasn't 100% sure about it, but I originally thought that the higher the better. But what the PE ratio basically states is how much you're paying compared to each dollar of earnings. So the PE ratio is used to value a company by measuring its current share price relative to its earnings per share. So what that means is the higher a PE ratio is, the more people are willing to pay a higher price because they're expecting the stock to earn more in the future. And the lower a PE ratio is, see, it's confusing. It says good earnings and it's priced unusually low, which could mean it's underpriced, which is good. However, if a company has a consistently low PE ratio, that could mean that they're running the risk of bankruptcy because they're losing money. And a negative PE ratio might not even be reported. Sorry, I don't think you can see the name of the website in the video. It seems to be cropped just below, but it's called Investment Zen. So if you want to have a read through this yourself, there's quite a lot in it. But this next section is very important. So a PE ratio is only useful compared to a benchmark. So a PE ratio of 10 could be pretty normal for a utility company, while it might be exceptionally low for a software business. So that's where industry PE ratios come into play. And also stock market indexes. So an index or an indices, it's one of those words, one of the few words where the plural form of the word has multiple different words you can use. So indexes and indices are the same thing. But an index is basically like a grouping, or it's like a hypothetical portfolio. This one, the S&P 500, is the Standard & Poor 500. And it's basically 500 top companies that are decided by a committee. So if you were to compare the S&P 500 average, which is about 13 to 15, the PE ratio average, about 13 to 15. But if you were buying a stock and it had a PE ratio of 20, that would mean that it's trading at 20 times its earnings, or a multiple of 20 of its earnings. And usually investors will invest in a stock that has a high PE ratio if they were pretty sure that the company's earnings were going to be higher in the future than they are now. And if the PE ratio is lower than the average, it sort of means that you're getting a good price for your current investment. However, if you're consistently getting a good price or a discount, that generally means that the company's not doing very well because they're not growing. So to make full use of a PE ratio, you need something to compare it to. So let's say you only invested in companies in the S&P 500, then you plan on investing in a single stock. You compare that stock's PE ratio to the average of the S&P 500. Or if you were investing in, say, Coca-Cola, and you wanted to know what its PE ratio was like compared to the rest of its industry, you would compare it to other beverages companies. But it's important to remember that a PE ratio is only really useful when you compare it to another benchmark, and it can be an index or it can be an industry. So to summarize, a price to earnings tells you how expensive a stock is relative to other stocks. And if you want to make full use of a PE ratio, of an individual stock, you can compare it to the index that it's in, or the industry that it's in, or the overall market average. And the overall market average at the moment is between 20 and 25, but it will change as time goes on. So a high or low PE ratio is not necessarily a good thing. I used to think that the higher the better. But a high price to earnings means that people are willing to pay more because they expect better earnings from the company in the future. And a low PE ratio can mean that it's a great price at the moment to get in. However, a consistently low PE ratio means that the company is not growing or earning money and therefore runs the risk of going bankrupt. And it's also very important to remember that a negative earnings per share, a negative price to earnings ratio is often not reported. But it's another one of those things that's entirely dependent on how involved you want to be and how active you want to be. So if you were actively trading or actively investing, you're doing it every day and putting in as much time and effort as possible, then a PE ratio will be a great help to you. But my own strategy means that I don't really have to worry about it because I don't intend on selling. I just pray that I'll find a good discount when it pops up and it doesn't get buried in all the other stocks in my portfolio. So most importantly, you need to keep in mind that it has to be compared to something else. The PE ratio needs to be compared to the index or the industry or the overall market. But I hope that this cleared things up for you a little bit. It definitely did for me. I used to think that the higher a PE ratio, the better. But evidently not. But I hope that this was useful, and I hope that you stop by again soon.